Okay, the next topic that we are going to discuss about is the books of original entry. Now, in the previous uh, topic, we discussed like how the accounts are being affected and how we debit each account and how we credit each account. But in accounting, it is not being done in that way. Okay, we have to record it in the books. Okay, and what these books are called? Journal. Okay, and these are considered as the books of original entry. We record in the journal. It is called journalizing. Okay, this is called when we record it in the books for the first time. It is called journalizing. Okay, now we record this. That is the first entry that we make, and how we make these entries based on the source documents. Mind it, based on source documents, we record them in the books, and that is called journalizing. Okay, how we record it in the books, I will show you a pro forma of it. Here we write the date on which the transaction has occurred. Here we write the particulars, which account is debited, which account is credited. Like I said, purchased goods on credit, purchase account, we like this, write like this, and we will keep write debit over here. Okay, and I purchase goods on credit. Purchase is my stock increases, I debit it. I purchased it on credit from Mr. Aman, so to Mr. Aman account, he becomes my liability. My liability increases, I will write it like this. I'll keep a space and write to whichever account is being credited. We will keep certain space and we credit. We don't write credit over here. Okay, we just write it to Mr. Aman account. Okay, then we write a narration being goods purchased on credit. Being goods purchased, this is an explanation that we give, that like what happens to this transaction. Okay, what happens to this transaction? We purchase the goods on credit, and then we make a line which means that this transaction is completed. Okay, now this transaction, after journalizing, we will record this in their personal account, in their accounts. Okay, in that particular account we are going to record this transaction. What is it called? It is called ledger. Okay, and here we will write ledger folio. What is this? It is the number on which that particular account is there. When we will write that number, when we will post these entries in the ledger, not before that. Okay, when we post these entries, when we post these entries, some post it weekly, some post it fortnightly, some post it daily, based on their transaction. What is the number of transaction happening based on that particular entity, and they post it in the ledger. Okay, when they post it at what particular number, that particular ledger is, that particular account is, at that time they will write that particular number. And here we will write debit and credit. Whatever amount is being debited, purchased worth rupees 30,000, I'll write debit. The account which is debited, I will write debit over here. Aman account is being credited by that same amount, I will write credit. Okay, so this is how we pass the journal entries. These are the journal entries, whichever transactions are happening in the business. If there is a source document, based on the source document, based on the proof and evidence, we record the transactions in our books of original entry. Minded books of original entry, they can ask you for NCQs. Okay, so We recorded in our books of original entry. We pass the journal entries. How we recorded? I'm repeating again. This transaction happened on which date? We will record that date. In the particulars, what transaction happened? We purchased the goods from whom? To Mr. Raman. We will give a narration, brief explanation of what happened in that particular transaction. After the narration, we put a line. Then here we will write the ledger folio number. This will happen when we will post these transactions to that particular account. Posting is called the ledger folio. From that ledger folio number, we will record that number. We will debit the account which has been debited, and we will credit the amount here which has been credited. Okay, this is how all the journal entries are being passed. This journal entry is in a particular book. Now this books, every transaction is happening when when it reaches the end of the book, we carry forward all the balances. Okay, 30,000, 40,000, 5,000. What happened? I carry forwarded all the whole amount. This 75,000 I carry forwarded to the next page. And in the next page, what I will write? Balance brought forward. Balance brought forward, debit side 75,000 and credit side 75,000. Okay, these are the balances that we have brought forward from the previous page. Okay, now this is how we are going to pass the journal entries. Again, we will deal with an illustration, and with that you get a more clarity. Just one more point I want to discuss with you. Here I have written purchases. Okay, what I have written? Purchases. I have purchased goods. I have not written goods here. I have not written stock over here, because goods are being dealt in different names. We will purchase it. We may return it. So it will be purchase, return. We sell it. So sales. We may return those goods. So sales, return, and the stock. Okay, so if we are purchasing it, we will write purchase account. If we are returning the goods that we have purchased, we will write purchase return account, sales account, sales return account, and the stock. Okay, now here this is a simple entry. Okay, one transaction is debited, one transaction is being credited. Now let's say I paid 50% of the amount to Mr. Aman. I purchased the goods for rupees 30,000. 15,000 I paid in cash. 15,000 I am still liable to pay to him. So what I will do here, two accounts are being affected. Mr. Aman account 50,000, 15,000 I'm liable to pay. Cash, my cash reduces, my asset reduces. So asset account is being credited 15,000. Okay, so this is called compound entry. The earlier one was a simple entry. The next, like if there are more than two accounts that are being affected, that is called compound entry. Now here we prepare, like I said, we do journalizing. We record the entries in the journal book. Okay, but there are numerous transactions happening. This is for the small business transaction, but we prepare other books also, like journal proper. If the transactions are being dealt in cash, we will make cash book, and there are subsidiary books. Now what is subsidiary books? Numerous transactions. I am purchasing from so many people, so many days, and returning the goods and selling the goods. So there is a particular book: purchase book, purchase return book, sales book, sales return book, bills receivable book, bills payable book. So there are, I will record that particular transaction in that particular book only. I will not pass a journal entry for that. I will record it in that particular book, and then there will be a ledger posting. Okay, we will deal with an illustration on how we will post the entries in the journal book. We are right now not going into these journal proper, cash books, subsidiary books. we will deal with it later. In this particular chapter, we will just pass the journal entries for the transaction and we will deal with that illustration. Okay. Okay, now let's pass journal entry of this particular transaction, right? What does it say? Mr. Ashmit started business by introducing cash rupees 5 lakh and building rupees 2 lakh on 1st of April 2025. He furnishes the following information for the month of April 2025. So these are the transactions that occurred on during the month of April. Okay. So what is the first transaction? Purchased goods from Mayank for rupees 30,000. So what will be our first entry? Purchases account debit. Our stock increases, and from whom we are buying? Mayank. Purchases account debit to Mayank account. Okay. Is this be the first entry? No. What is our first entry? Our first entry is this. He started business by introducing cash, rupees 5 lakh and building rupees 2 lakh. So never start the entry, like there is an information given already here. So you have to start with it. Okay. So what will be our first entry? The cash comes into the business, building comes into the business, both are our asset, both the asset increases, and who brings both these assets? The owner, that is Mr. Ashmit. Okay. And he is the liability of the organization or an entity, whatever. He is the liability. He is introducing the capital, so the capital also increases. So what will be the entry? Asset increases, so cash account debit, building account debit 2 lakh, to capital account, our capital is also increases, so capital increases, we credit it and the credit amount will be 7 lakh. So cash account debit, building account debit 2 lakh, to capital account 7 lakh. So here we will write the narration, that is the explanation, that being business started by introducing cash and building. Okay, so this is how the format will be. First, we will write the journal entries in the books of Mr. Ashmit. Here we will write here it will be a date column, particulars, ledger folio. This number we are not going to record it right now. When we will post it in the ledger, at that time, that page number we will write it over here. Here we will write the debit amount, whichever account is being debited, that amount we will debit it over here. And here we will write the credit amount, the amount which is being credited, here we will write it. Okay. Now comes the another entry, that is purchased goods from Mayank for rupees 30,000. He purchases the goods. The stock is increasing from Mayank. Here it has not been mentioned that he is buying it on cash or credit. So you need to remember that if nothing is mentioned, that means he is buying on credit. If it has been mentioned that he purchased goods from Mayank for rupees 30,000 on cash, then it is a cash entry. Otherwise, it is considered as a credit entry. So what will be the second entry? Purchase account debit 30,000. Our stock increases, so it will be debited to Mayank account. He is our creditor. Okay, he is our creditor. So our creditor increases. This account will be credited by rupees 30,000. Purchase account debit, if you consider it as a traditional approach, the goods come into the business, debit what comes in, and this is a personal account, credit the giver, we credit Mr. Mayank account. Okay. Being goods purchased on credit 30,000. Next entry is purchased stationery for cash rupees 2,500. Okay. So on, sorry. So the second entry is deposited rupees 3,50,000 in bank. Okay. So we deposited 3,50,000 in the bank. The bank is an asset. Asset increases, we will debit it. Bank account debit. Cash decreases, we will credit it to cash account 3,50,000. and the narration will be being cash deposited in bank. Now you must notice that after every transaction we have to make a line, we have to end this transaction. This means this transaction is ended, so we have to make a line over it. Okay. The fourth transaction is purchase stationery for cash rupees 2500. Okay, so stationery expense, our expense increases, we debit it. Cash, our asset decreases, we credit it. So stationery debit all expenses and losses, and cash real account credit what goes out. So stationery account debit 2500 to cash account 2500, being stationery purchased for cash. Okay, now you get to know how we are recording the transaction. Okay, it's easy. You just need to keep in mind whatever approach is comfortable for you. May it be modern approach, may it be traditional approach, whichever approach you find suitable, you find comfortable. Just remember the rules of debit and credit, then it will be very easy for you to pass the transactions. Okay. Next is goods sold to Shashank for rupees 40,000. Now here also we are selling the goods to Shashank. Here also we are not mentioning whether it is on cash or credit. If it is not mentioned, that means we are selling the goods on credit. Okay. Goods are going out from the business and Shashank is our data. Okay. Our data increases. So we will debit Shashank account debit to sales account. Now remember, here I am not writing goods, here I am not writing goods. These are purchase, this is sales. There will be purchase return, sales return. These things we are supposed to mention when we are dealing with the stock. Okay. So Shashank account debit 48,000 to sales account 48,000, being goods sold to Shashank on credit. Purchased furniture for rupees 25,000 by paying check. We are purchasing the furniture. Furniture is an asset. Our asset increases. What we are paying, how we are making the payment? By paying the check. The bank balance reduces. Bank, our asset decreases. We will credit bank account. So here one asset is increasing, furniture account is being debited. One asset is decreasing, our bank account is being credited by an amount of rupees 25,000. And our narration will be being furniture purchased by paying check. I made a line. Okay. Next is cash rupees 7,000 withdrawn for personal use. Now cash is being going out from the business, and who is taking that cash? The proprietor, the owner, that is Mr. Ashmit. So what is it being called when something is going out from the business and the owner is taking it? It is considered as drawings. Whatever is taking, whatever, if he is taking certain goods also, that is will be termed as drawings. Okay. So drawings account debited to cash account. Cash is being, our asset is being is reducing, so cash account will be credited 7,000 being withdrawal of cash by proprietor for personal use. This is a simple entry. Goods sold for cash rupees 17,000. Here it's clearly mentioned that we are selling the goods for cash. Goods are going out from the business. Cash, we are receiving cash, our asset is increasing, so the entry will be cash account debit to sales account 17,000, being goods sold for cash. Now here you will see that the page is completed. What we will do, we will total all the debit amount, we will total all the credit amount, and here we will write the total of everything. The total is 11,79,500, and here we will write whatever balance we are carrying it forward to the next page. We will write total carried forward. Okay, and this balance we will take to the another page, and it is will be total brought forward 11,79,500. Right. Now comes another entry, which is return goods to Mayank rupees 5,000. We purchased Mayank, the first entry. We purchased goods from him for rupees 30,000. Now out of 30,000, we are returning him. How much amount? 5,000. Now goods are going out from the business. Mayank was our liability. Our liability is now reducing. It is decreasing. What we will do when the liability reduces, we will debit it, and the goods are going out from the business. Our asset is reducing. Our stock is reducing. So Mayank account debit to purchase return account 5,000. Being goods returned to Mayank on April 15th. Next entry is Shashank paid rupees 47,000 for full and final settlement through check. Here it is mentioned full and final settlement means he is paying off. He was supposed to pay how much? 48,000. He is paying us 47,000. That means 1,000 difference is what? It is the discount we give it to him. Okay, and that discount is what? That discount is an expense for us. So he made a payment through check. Okay, so our asset increases, bank account will be debited. We are 47,000 and we are closing the account of Shashank. He is paying the full amount. So we will do what? We will credit him. He is our debtor. Our debtor reduces. We will credit him. The difference is considered 1,000 is what? It is the discount that we allowed to him. It is an expense. We will debit it by rupees 1,000. Being check receipt from Shashank for final settlement. Okay. Check issued to Mayank for rupees 15,000 and balance in cash. Balance we paid in cash 15,000. We issued a check to him. How much amount of goods we bought from him? 30,000. Okay. How much we are paying through check? 15,000. So the balance will be what? 15,000 through cash? No. We have returned goods to Mayank. So you need to consider this. We have returned goods to Mayank rupees 25, worth rupees 5,000. So we purchased him for rupees 30,000. 5,000 we returned goods to him. So we are liable to pay to him 25,000. Out of 25,000 we are paying 15,000 through check. So the balance is 10,000 that we are paying through cash. Okay, so you need to consider these entries when they are coming. Like if you are liable to pay to Mayank, have you returned it? So yes, we have returned it. Same way, if there is a sale entry and that person has returned goods to us, that thing you have to take into mind. Okay. So we have issued check to Mayank worth rupees 15,000 and balance in cash means 10,000 we have given him in cash. Now Mayank was our creditor, our liability is getting reduced. So what we will do, we will debit Mayank account. Now our two assets are reducing, bank and cash. We will credit them by 15,000 and 10,000. Being payment made to Mayank through cash and check. Okay. Now there are two simple entries, that is paid wages rupees 2,000. Wages are our expenses. Our expenses increases. Wages account debit. We are paying, not mentioned here. These are small petty expenses. If it is not mentioned, we consider that we are paying through cash. Now you have to keep in mind, in business, any transaction above 10,000 we can't give in cash. This is a very important point. If any transaction is about rupees 10,000 and it is not being mentioned by through what we are making a payment, we have to consider that we are giving a check to that person. Okay. Now here it is wages rupees 2,000. So wages account debit, our expense increases. To cash account, our asset decreases by 2,000. Being wages paid. Paid check for electricity bill rupees 6,000. Electricity bill, again, it's an expense. We are paying through check. That means our bank balance is reducing. So here our expenses are increasing. We will debit our expenses. and our bank balance is reducing, our asset is reducing, we will credit our asset. So electricity bill account debit 6,000 to bank account 6,000, being electricity bill paid through check. Okay, and our last entry is bank charges rupees 300. Now bank charges are rupees 300. Now, here it is not mentioned, okay, whether we are paying through cash or whether we are paying through check. But this is something the bank is automatically deducting from our balance, okay, from the balance that we have in our bank account. They are debiting our account by that much amount, okay. So, bank charges becomes what? It becomes our expense, okay. So, bank charges account debit 300 to bank account of a balance. Bank balance is reducing, our asset is reducing by rupees 300, being bank charges deducted from bank account. We made all the entries, we did all the entries, and now we total it. The total on both the side will be the same, because the same entry, the same amount is being debited and the same amount is being credited. So it will be 12,65,800, and we'll make two lines. It's the sign of equality, that they are now balanced. Okay, I hope you got to know how we pass the journal entries. Okay, now next thing we are going to take is GST, right? The next topic that we are going to discuss about is accounting entries under goods and service tax. Now, what are goods and service tax? We have already discussed about it in our second chapter. Let me just give you a brief note about it. Goods and service tax based on consumption of goods and services. It is a destination based tax, and the form is CGST, SGST, and IGST. Within the state, if any transactions are happening, there will be a clear bifurcation between CGST and SGST. But between two states, if any transaction are happening, we will charge IGST. Okay. Now, in our example, when we purchase the goods, whatever we are consuming, whatever services we are taking, we are paying taxes. Okay. So now what happens? In the organization take a credit of it. If I am purchasing goods, if I am giving GST on it, I can take a credit of it when I'm selling those goods and services. Okay, whatever I am purchasing related to the organization, related to the entity, and I am paying the GST for it, I can take a credit of it. Okay, now let's take our one example of mobile phone, right? Now I purchased mobile phone. So purchase account is debited. Okay, I purchased mobile phone worth rupees 30,000. Okay, now when I purchased it for rupees 30,000, I purchased it. I have to pay GST. So input CGST account, that is my expense, and input SGST account is debit. Okay, input CGST account, input SGST account, let's say 5%, 5% CGST and 5% SGST. Okay, so how much I am paying to Mr. Aman? I will credit his account, he is my liability. How much I am paying to Mr. Aman? I am paying 33,000. Okay, now if I am selling the same goods to somebody for rupees 50,000, I am selling to Mr. Rajiv goods worth rupees 50,000. He is the to whom I am selling. Okay, he is the debtor, debit the receiver, or he becomes my debtor, asset increases. So Mr. Rajiv account I am debiting. By how much amount I will debit? First, I will sell the goods worth rupees 50,000 to sales account. I will collect output CGST at the rate of 5%, and output SGST. I will collect CGST and SGST from him. Okay, so how much I will collect? I am selling goods worth rupees 50,000, and this 2,500, 2,500 is the output CGST and SGST I am collecting from him. So in total, he is liable to pay me 55,000. Right now, I have to pay. This GST is not mine. Right, this GST does not belong to me. This is belongs to who? To the government. I am liable to pay to who? To the government. So when I am collecting CGST and SGST from Mr. Rajiv, 2,500 and 2,500, I will say I have already paid CGST and SGST from when I purchased the goods. So I will deduct this amount, 1,500 and 1,500. Now I am liable to pay just rupees 1,000 CGST and SGST. So here what I did, I took a credit of CGST and SGST what already I have paid. Okay. I will tell you an example how to deal with it with IGST also. Okay, so as we have already discussed about GST, what is GST? We know that GST is something, the tax which the business is collecting and the business person is liable to pay to the government. When the business is dealing in any transaction which is within that particular state, then they have to collect CGST and SGST, and they are supposed to pay that to the government. Okay, that is belongs to central government and state government. But if the business is dealing in any transaction between two states, then comes IGST. Okay, and how to deal with it, how we can take the credit of it, like when we are purchasing and when we are selling the goods, we are liable to pay the government, and how we can take credit of it. In this illustration, we are going to take it. Okay, so, record necessary journal entries in the books of Akash of Gujarat, assuming CGST at the rate of 9% and SGST at the rate of 9%. If nothing is mentioned about IGST, that means it is between two states, CGST plus SGST, that is 18%. Okay. So, the first entry is what? Bought goods rupees 5 lakh from Kabir of Gujarat. The person from whom he is buying belongs to Gujarat only. That means it is within the state. He is from Gujarat. He is purchasing goods from Gujarat. What he will pay to that person? He is supposed to pay to Kabir GST. Okay. So how much amount he will pay to Kabir? 5 lakh worth of goods he is purchasing. 9% CGST he is paying. 9% of 5 lakh is 45,000, and 9% SGST he is paying, that is 45,000. So our first entry, purchases account debit 5 lakh, input CGST 45,000, input SGST account debit 45,000 to Kabir account 5,90,000. He purchased these goods worth rupees 5 lakh and he is paying 90,000 GST. So in total he will pay to Kabir 5,90,000, and as he has paid GST, he can take a credit of the same. Okay, when he is selling and he is liable to pay to the government, he can take a credit of the same. Okay, now the second entry is what? Bought goods rupees 2 lakh from Reena of Maharashtra. Okay, now Reena belongs from where? Maharashtra. Akash belongs from where? Gujarat. What is it? It is between two states. So here what will come? What he is supposed to pay, because he is buying goods. So what he is supposed to pay? IGST. So what will be the entry? Purchases account debit 2 lakh, input IGST account debit 9%, 9%, that is 18%. 18% of 2 lakh is 36,000 to Reena account, that is 2 lakh 36,000. So being goods bought, he is paying IGST to Reena. Okay. The third is sold goods rupees 1,50,000 to Praveen of Rajasthan. Now he is selling goods worth rupees how much? 1,50,000. Okay. What he will collect? He will collect CGST as well as IGST? No. What he will collect? He will collect only IGST. Okay. From why? Because Praveen belongs to Rajasthan, he belongs to Gujarat, that is also between two states, so he will collect only IGST from Praveen. Okay, so Praveen account debit. First, he will sell 150,000. 18% of 1,50,000 is 27,000. So, how much amount he is collecting from Praveen? 1,77,000. Okay. The fourth entry is paid for railway transport rupees 10,000. He is paying for the railway transport charges. Okay, on that also he is paying GST. Okay, so transport charges account debit 10,000. Input CGST account debit 900. Input SGST account debit 900. To bank account 11,800. Okay. Now, again, what he is doing? He is buying furniture. What furniture for office use? Rupees 40,000. Furniture also he is going to pay GST. Okay. He is paying what? CGST and SGST. Furniture account debit 40,000. Input CGST account debit 3,600. Input SGST account debit 3,600. So in total he is paying 47,200. Okay. And the last entry is sold goods rupees 8 lakh to Rihan of Gujarat. Gujarat. He belongs to Gujarat. Rihan also belongs to Gujarat. What he will do? He will collect 9% CGST and 9% SGST from Rihan. How much amount he is selling? Worth of rupees goods. He is selling 8 lakh worth rupees of goods. He will collect 9% CGST, that is 72,000. 9% SGST, that is 72,000. So in total, Rihan is supposed to pay 9,44,000. We will carry forward this balance and now we will do the working. Okay, now the working I have explained it here. What he has done, how much he is liable to pay CGST? He is liable to pay to the government. CGST, he is not liable to pay anywhere. One time only he is selling in the state of Gujarat. Okay, so how much he is liable to pay? 72,000 and SGST is 72,000. IGST, how much he is liable to pay? 27,000. Now his liability of CGST and SGST is 72,000 and IGST is 27,000. Okay, but as he has already paid CGST and IGST multiple times, he can take a credit, input tax credit of the same. Okay. So IGST 27,000. IGST, how much credit he can take? 36,000. But he is liable to pay only 27,000. Okay. So the remaining 9,000 credit from where he will take? He will take it from CGST. Okay. He can take a credit. Let's say if it is more than this, he can take a credit. If the balance of CGST got finished, he can take a credit from IGST. But first he will take a credit from CGST. And still if there is some balance left, he can take it from IGST. Okay. Now IGST balance is nil. He is not supposed to pay IGST. CGST, how much credit he can take? CGST 45,000. Then again 900. Again 3,600. Okay. So total 45,000 plus 900 plus 3,600, that is 49,500 CGST. Similarly, SGST 49,500. This much tax credit he can take, 49,500 and 49,000 from SGST. 27,000 IGST he has taken credit, remaining 9,000 he will take it from CGST. Now how much he is liable to pay? 13,500 CGST, 22,500 SGST and nil in IGST. So first he will debit CGST, output CGST account debit 58,500 because he is taking his liability reduces, and input CGST as well as SGST will be credited. Similarly, he will take a credit of SGST. So output SGST account debit 49,500 to input SGST account 49,500, and he will take off IGST. Output IGST account debit 27,000 to input IGST account 27,000. Now he has to make a payment. He will debit output CGST account debit. How much he is liable to pay? 13,500. Output SGST account debit 22,500 to electronic cash ledger account 36,000, being final payment made. I hope you understood how we will do the calculation. This is the working note. If you want to take a screenshot, take a screenshot. If you face any difficulty, please let me know. Okay. Okay, the next topic that we are going to discuss about is ledger. Now, before I tell you what is ledger, let me again start with an example. The example from where we purchased mobiles from Mr. Aman. Okay, so on 1st April, I purchased mobile from Mr. Aman. So my entry will be purchase account debit to Mr. Aman account 30,000. Okay, then again on 10th of April, I purchased more mobiles worth rupees 50,000 from Mr. Aman. Okay, now certain mobiles were not working properly, so I returned Mr. Aman those goods to purchase return account worth rupees 10,000. This is just an example. In businesses, frequent transactions are happening, and when they want to settle the accounts, when they want to know how much liable, how much due amount is it, how much they are liable to pay to their creditors, or how much they are liable to, how much they are owing to somebody, how much somebody, how many are their debtors, they are not going to take their journal entries and try to do it on the calculator, like okay, this much amount, this much amount. It's a tedious thing. Okay, what they will do, they will prepare, like in this case, I'll prepare Mr. Aman account. I purchased goods worth rupees first 30,000, then 50,000. I returned 10,000. Now I'm liable to pay how much? 70,000. Okay, what is this called? What this process is called? It is called posting, ledger posting. So from here comes the word ledger posting. What is this ledger? It is considered as the principal book of entry. It's considered as a principal book of entry. Okay, journal is a book of original entry. This is the principal book of entry wherein we record each transactions that has occurred into that particular account. Okay, they have been classified. There are the organization prepares separate sheets, separate cards for them. Every account is on a different page. Okay, and on that they will record each transaction, which account is being affected all the time, they record in that particular page. So that is called as ledger posting. Now how the ledger account is prepared, let me give you a pro forma. We will write the name of account. Okay, in this case, Mr. Aman account, right? Whatever is being debited, it's a T format. Okay, I'm just making a line so that you get to know this is the separation line. Okay, whichever account is debited, this side, it is called a T format. This is considered as the left side and this is considered as the right side. So whichever account is debited, we will post it on the left side and credit it on the right side. Okay, here we will write the date, whichever transaction, like on 1st April I purchased, like that. Here it will not come. Whatever date, then the particulars, the details. In details, we will write like I purchased goods from Mr. Aman. Purchase account is debited. Mr. Aman account is credited. So Mr. Aman account on the credit side, I will write by purchase account 30,000. Here I will write the journal folio number on what particular page. It's a page number of the journal book. Okay, on what particular page this transaction has been recorded. I'll write that number, amount, rupees. Same way here, date. This is the right side, particulars, journal folio, amount, rupees. So that's how I will record. I purchased, I gave a journal entry, then I will post, okay, on 1st April, I purchased worth rupees 30,000. Then on 10th April, again I purchased. What was the entry? Purchase account debit to Mr. Aman account. So Mr. Aman accounts on the credit side, I am going to write purchase account. Okay. The number and it was 50,000. Now on 12th of April, I returned the goods. So what was the entry? Mr. Aman account debit to purchase return account. So Mr. Aman account debit on 12th April, I returned. So to purchase return number and how much I returned? 10,000. How much balance I'm supposed to pay? 70,000. And like that, my account is prepared. Mr. Aman account is prepared. This is called ledger posting. Okay, right? Now, this ledgers, like there are 5 categories. There are 5 categories: assets, liabilities, capital, expenses, and income. Related to this only, we will prepare all the accounts. Okay, now this accounts have been divided into two parts: permanent account and temporary account. Assets, liabilities, and capital, they have been categorized as permanent account. They are the permanent account which we are going to show in our balance sheet, like how much is we are owing to somebody and how much we owe to somebody. Okay, so assets, liabilities, and capital will be showing in the balance sheet as a permanent account, whereas the expenses and the income, they are considered as a temporary account. We close this account and we will transfer them in the trading and profit and loss account, which will show us, we will close these accounts. Okay, like at the end of the month, at the end of the year, I'm not going to close Mr. Aman account because I am liable to pay. This is my liability. This is my permanent account. I'm going to show it in as a liability. Okay. But my expenses and income, like I'm paying rent, salary, advertisement expenses, electricity expenses, these are temporary accounts which will show me while doing the business for that particular year how much income I have earned, how much expenses I have incurred, and what is my profit and loss on the basis of these expense and income. So these are the temporary accounts. I will close them and I will transfer them to the trading and profit and loss account. So now you understood what is journal, what is ledger. Let me tell you the difference of them. Okay, the difference now between journal and ledger. What is the main first difference? This is considered as the book of original entry. Okay, and this is considered as the principal book of entry. We can say it's a second entry. It's the second entry. This is the first entry. This is the second entry. Okay, so when we record the transaction journal, it is called journalizing, and in ledger it is called posting. Okay, the third, okay, the third is what we record the transaction. When we record the transaction, they are in journal in a chronological order. We record the transactions in a chronological order. Transaction occurred, we record them in the books. Here we post them. We analyze the transaction and then we record them. We analyze it in the journal and then we make an account. So it is called an analytical order. The basis of this is transaction. What is the base of recording the entries? It's based on the transaction. Transaction occurred, we record it. Here we are preparing the accounts of those transactions. The accounts are being prepared. So that is the basis which within the ledger, the base of that transaction. Okay. This is of greater importance as compared to ledger. Why? Because when we record the transaction in journal, it is based on certain evidence. It is based on the source document. On the basis of source document, we record the transaction in journal, whereas we post them considering the transaction that occurred in the journal. This is just posting. Okay, this is posting which is on the basis of journal. But journal, when there is a source document, when there is an evidence, we record the transaction. So this is of a greater importance as compared to ledger. So in this chapter you got to know what is ledger, what is journal, how the accounting entries are made, what are the rules of debit and credit. We are going to deal with one illustration wherein I will cover all the entries related to the wherein we will do the journal entries as well as ledger posting. Okay, so we already passed the journal entries in the books of Mr. Ashmit. Okay, I'm taking the same example so that it's easy for you to understand also. Okay, I'm taking the same example wherein we will do ledger posting. Okay, so the first entry was he brought in cash, he bring the building and started the business. Okay, so first account we will make is cash account. Okay, now these things you are supposed to consider whenever you are preparing a ledger account. Here you are supposed to write debit. All the debit entries will come on this side, on the left side. Here you are supposed to write credit. All the credit will come on the right side. Okay. Date, particular, journal folio, whichever number on whichever page the journal entries have been passed, we have to write it. The amount column. This is the credit side. Same date, particular, journal folio, amount, rupees. Okay. Now, when we are preparing a ledger account, when we are doing the posting, what is the entry? Cash account. So we will make a cash account. Okay. Now here the cash account is being debited. Okay. Try to understand the entry, like here the cash account is debited. So on the debit side of the cash account, we have to record the entry that is worth rupees 5 lakh. Okay. On which date? 2025 April 1st. What we will write in the particulars column, like cash account is being debited, but how does the cash comes into the business? Who brings in the cash? Okay, so that thing we are supposed to mention it over here. So cash is being brought by the owner. Okay, he has introduced in the form of a capital. So what we will write here? 2 capital account. This will give us a clear idea. Okay, cash account, cash comes into the business. How it comes into the business? In the form of capital. Okay. Now, when we are writing on the debit side, we have to write 2. When we are writing on the credit side, we will write over here by. Okay. Now, for simplicity, I'll be making cash account and bank account little longer because there are more entries related to cash and bank, so that it's easy when we are preparing the performer. Try to make cash account and bank account a little longer so that the entries easily get accumulated over here. Okay. The second is he brings in cash, he brings in building. Okay. So here I am preparing building account. Okay. Same pro forma, debit, date, particulars, journal folio, amount rupees, left side, and on the right side, credit side, date, particulars, journal folio, amount rupees. Okay. Now the building also comes into the business. Building account is being debited. Okay. 2025 on April 1st. Who brings in the building? The owner in the form of capital. So to capital account 2 lakhs. Okay. And now we will prepare the capital account. Okay. Capital account is being what? Credited. Capital account is being credited. Okay. So credit side 2025 April 1. What capital, in the form of what capital he has introduced? In the form of cash account 5 lakh, and in the form of building by building account 2 lakhs. Okay, easy peasy. Okay, now the second entry is he purchased goods from Mayan. Okay, so the goods comes into the business. We'll prepare purchase account. Here we will prepare purchase account. Okay, purchase account, goods comes into the business. From whom we buy it? 2025 April 1. Purchase account debit, from whom we buy it? From Mayank. So to Mayank account 30,000, and Mayank is our creditor. His account is being credited by how much amount? What he brings? He brings the goods. From whom he buy the goods? So by purchase account. This will give an explanation. Okay, we purchased from Mr. Mayan 30,000. Okay, the next was we deposited cash into the bank. Okay, so the cash goes out from the business, bank account is being debited. So here I am preparing bank account 2025 April 1st. Okay, so bank account debit, what we deposited, the cash we deposited. So to cash account 3,50,000, and at the same time cash reduces, it goes into the bank. So in the credit side we will write, sorry, I'm by mistake the date. Okay, by bank account, where does the cash goes? In the bank. How much amount? 3,50,000. Okay, next is we purchased stationery for cash. Okay, so stationery is an expense. We'll prepare stationery account. Stationery account is being debited. It is an expense. On 3rd April we did it. So In form of cash, we bought the stationery 2500, and our cash reduces. It will get credited. Cash account is credited. Why it is credited? Because we bought stationery. Okay. So 2500. Next is on April 5th, we sold goods to Shashank on credit. Okay. So now we have to prepare Shashank account. We sold it on credit. So Shashank account will be debited. Shashank account debit. What we did? We sold the goods. He is the receiver. So his account is debited. He is our debtor. Our asset increases. We will debit it. So to sales account 48,000. At the same time, we will here prepare sales account to whom we sold April 5. To Shashank we sold. So by Shashank account will be credited in the sales account. Okay, by amount of 48,000. And now the next entry is furniture account debit to bank account. We purchased furniture by paying check. So furniture account, here we will prepare furniture account. Furniture account is being debited. We purchase the furniture comes into the business, and we give a check for the same. So to bank account by rupees 25,000, and we will, our bank balance reduces. We've got a furniture, our bank balance reduces. 25 April 8. What we bought? We bought furniture. 25,000. Okay, now this is how we post the entries in the ledger. I have explained you all the entries and it's easy. I hope it's easy for you and I want you to do it. Prepare other ledgers, post all these entries, and for your convenience, I will just take a screenshot. I will record all these entries, post it, and I will share a screenshot at the end of the video so that you can easily compare and you can make out if you have made any mistakes, and if it is fine everything, then it's good to go. So, okay, let's end it over here and I will share you the screenshot. Hope you got everything well. Thank you.